So if you've just returned from the holiday break, you're probably feeling that strange whiplash,
Oh, yeah.
that feeling of going from seasonal calm right back into a highly volatile, shortened trading week.
Absolutely. Everything is surging or plummeting all at once.
Yeah.
It's a lot to take in.
Okay, let's unpack this. Our sources have delivered a real information buffet. We're covering everything from market records to these dramatic policy debates.
And not just that. Wealth tax,
Mhm.
AI safety, and even the literal reshaping of cities just to get to critical resources.
Exactly. So the goal today is to synthesize all of these competing narratives. We want to deliver the key insights you need as we close out 2025 and really look ahead to the big themes of 2026.
And what's fascinating to me here is the stark contrast. You have this market euphoria on one side,
Right. Record highs.
record-setting highs in equities and precious metals, all driven by this optimism over Fed rate cuts.
Yeah.
But then on the other side, you see these deep structural anxieties emerging.
In supply chains, housing.
Supply chains, the quality of housing across the U.S., and these really intense regulatory efforts. I mean, trying to protect our emotional health from AI. It's a world that's simultaneously soaring and straining.
Let's ride that soaring market first then. Despite the holiday slowdown, we definitely saw the famed Santa Claus rally play out successfully.
It did. Major indexes all notched wins in that holiday-shortened week. That's their fourth positive week in the last 5.
And these aren't just small wins.
No, not at all. These indices are hitting major psychological thresholds. The S&P 500 logged fresh records, and it got, within 1% of the 7,000 milestone.
Incredible. And for the full year, how does 2025 look overall?
For the full year, it was a banner year. You've got the S&P 500 up over 17%, the NASDAQ is up over 21%, and the Dow has gained about 14%.
Just pure bullish territory.
Absolutely.
But you pointed out that the first day back from the break saw some pullbacks, so the bulls can't really rest yet.
Exactly. We saw losses, and particularly in those mega-cap tech names that have driven this entire rally.
So NVIDIA, Meta.
NVIDIA dropped more than 1%. Meta, Oracle, Palantir, they also suffered. So it just reinforces this idea that if stocks are going to close the year on a high, tech really needs to continue doing the heavy lifting.
And what does the ongoing lag in small cap stocks tell us? We keep seeing the Russell 2000 underperforming.
That's a huge structural indicator we have to watch. The Russell 2000 is poised to notch its 5th straight year of lagging the S&P 500.
5 years.
5 years. So for you, the listener, this means the market's enthusiasm is, it's highly concentrated in a few very large companies, usually tech giants.
Right.
The small cap segment, it represents a much broader economic health. It's the risk appetite outside of big tech. So when it lags this persistently, it suggests that while the high flyers are doing well, the average American business is still struggling.
A sign of concentration, not necessarily broad health.
That's it, exactly.
Okay, that concentration risk is key. Now, the biggest shockwave this week, it wasn't even in stocks. It was in commodities. Let's talk about the absolute whiplash we saw in silver.
Manic is the word for silver's movement. Just manic. In overnight trading on Monday, silver topped $80 an ounce for the first time ever.
Ever.
And then almost immediately, it plunged 15% from peak to trough. That is the biggest high-to-low change we've seen in years.
So what forces are strong enough to cause a surge like that and then an immediate sharp reversal?
Well, the underlying drivers for the rally itself are really powerful. You have expectations for Fed rate cuts in 2026, which is pushing the dollar down.
And geopolitical tensions.
And geopolitical tensions, right?
Mhm.
When we talk about gold being up 60% year to date and silver up 140%, what we're seeing is the re-emerged value of gold as a monetary hedge.
Okay, hang on. For listeners who might not be familiar with that term, what exactly do we mean by monetary hedge?
It just means investors are turning to gold as a store of value, a safe haven, really, when they fear inflation will eat away at the value of paper currencies like the dollar, or when they fear global instability. Gold historically maintains its purchasing power.
And silver just rides that wave.
It benefits from it, yes, but silver has that extra industrial layer that gold doesn't.
Right. The industrial demand for silver, is that where the future growth is?
Absolutely. I mean, strong industrial demand is a major price floor for silver, specifically for these high-growth sectors like solar panels, data centers, electric vehicles.
So analysts see that plunge this week as just profit-taking.
Exactly. Not the rally ending, but a reset after hitting that $80 high. They expect the tailwinds from demand and, inventory depletion to continue. It could push silver into the $90 to $100 range in 2026. The industrial pull is just too strong.
Okay, moving back to the central banks. It was a light week for economic data, which kept investor focus squarely on the minutes from the Federal Reserve's December meeting.
It did. And we saw the 10-year Treasury yield dip slightly, which is basically the market breathing a sigh of relief.
Because yields move inversely to prices.
Right. When the yield dips, it means investors are pricing in a higher likelihood of rate cuts. However, Citibank's head of equity research, Jacob Peterson, he sort of threw some cold water on that.
What did he say?
He anticipates at most one Fed rate cut in 2026. And crucially, he pointed out that this is less than what investors are expecting right now.
So that creates a potential tension point.
A huge one if the Fed proves to be more hawkish than the market currently assumes.
That market anxiety over physical inputs, from interest rates to silver demand, it translates immediately into geopolitical reality. So let's talk about the rare earth scramble.
Gotcha.
How critical are these resources, and why is this competition suddenly reshaping global policy?
They're not just metals. I mean, they're the literal foundation of the digital and green transitions. Rare earth magnets power everything.
Everything from EVs to weapons?
EVs, wind turbines, AI components, precision weaponry, all of it. The problem is simple concentration. China dominates. It's responsible for nearly 60% of global mining and over 90% of magnet manufacturing. That creates an immense security and economic vulnerability for the West.
So the counter-strategy is this frantic, expensive scramble to build a mine-to-magnet supply chain outside of Chinese control.
Exactly. You see, the EU has its Critical Raw Materials Act, aiming for 40% domestic production by 2030. And they're already executing on this.
Right, in Estonia.
Yes. The Canadian company Neo Performance Materials just launched a magnet factory in Narva, Estonia, literally on Russia's doorstep. This isn't just economics. They're calling it critical for Europe's sovereignty.
And the U.S. is following suit with direct federal funding.
Yes. In North Carolina, a magnet producer called Vulcan Elements received a huge $620 million direct federal loan from the Department of Defense.
From the DoD.
From the DoD, yes. It shows you that governments are now viewing industrial output as a defense mechanism.
Well, that scramble leads to one of the most astonishing stories in our sources, the ultimate trade-off in Kiruna, Sweden. They're literally moving an entire city.
The story is unbelievable. Kiruna is way up there, 145 kilometers north of the Arctic Circle. And thousands of residents, centuries of community, are being relocated 3 kilometers east.
And why? Because the ground is collapsing.
The ground is collapsing due to ground subsidence. For our listeners, that means the land is literally sinking or caving in because of all the mining expansion underneath it.
And the engine causing this is the LKB iron ore mine.
Precisely. LKB accounts for 80% of all EU iron ore. And to keep getting at that, and crucially, this newly found massive rare earth deposit, the city just can't stay where it is.
The dependency is total.
It's total. The municipal council chairman said it perfectly. We live on the minerals. So this forced relocation, which includes the 2-day move of the 113-year-old Kiruna church.
Moving a church.
It really puts the phrase cost of progress into stark relief. The physical needs of the modern world are literally uprooting history.
If the resource wars are impacting cities, they're certainly hitting consumer goods. We're seeing tariffs and scarcity throwing the leather industry into chaos.
Well, it's a perfect storm. Tariffs on imports from China, Vietnam, India, plus supply chain bottlenecks. But the biggest domestic factor is the U.S. cattle herd.
It's shrinking.
It's at its smallest point since the 1950s. Fewer cattle mean fewer hides, which drives up the core cost. So analysts project leather goods prices could climb roughly 22% over the next year or two.
Wow.
And instead of restoring U.S. manufacturing, companies are mostly just reshuffling suppliers overseas.
Finally, on the geopolitical front, we saw some very high-stakes diplomatic movement over the weekend centered around peace talks in Florida.
The talks were significant, yes. For Ukraine, President Zelensky asked for up to 50 years of security guarantees.
50 years? That's a huge jump from the 15 being discussed.
A huge jump. And while President Trump said a deal is close to 95% done, the land... So, territorial issues like Donbass. That remains a thorny issue.
And we saw a reaction in the markets.
A brief one. European defense stocks dipped a little on hopes of peace, but analysts were quick to say long-term defense investment in Europe will now accelerate massively. It's seen as necessary.
And the message on the Middle East was just as strong.
It was. Trump stressed that the second phase of the Gaza ceasefire requires Hamas disarmament, and he delivered a very clear threat to Iran, saying he would knock the hell out of them if they try to rebuild missile reserves or their nuclear program. So the tension remains incredibly high.
As resources get scarce and expensive, it fundamentally changes what we value, right? And how we consume. So let's pivot from physical resources to our leisure time. The free ad-supported streaming service Tubi is just exploding.
This is a massive cultural shift. It's driven by subscription fatigue.
Yeah.
Fox-owned Tubi hit profitability this year, and it is gaining serious traction.
I saw it surpass Peacock and HBO Max in streaming minutes.
It did. In November, it hit a 2.1% share, and it's fueled by cost-conscious consumers. Nearly 60% of its audience is millennials and Gen Z.
And their usage model, that seems to be the key for advertisers.
It is. Tubi says 95% of its viewing is on demand, what they call lean-in viewing. People are actively searching for content, not just passively watching.
Which is a much stronger pitch for an advertiser.
A much stronger pitch. It proves that a young, cost-aware audience will absolutely trade their attention for free content.
Okay, so on the complete flip side of that, you have the ultimate luxury divide. We're seeing premium credit cards with, astronomical annual fees, up to $895.
And they're thriving. It's a clear indicator that wealth concentration continues.
Yeah.
These cards are powered by two key groups: wealthy over 50 silver spenders and millennials who want the exclusive travel perks.
Airport lounges, experiences.
Exactly. The price of access to luxury is clearly not a barrier for those with high net worth.
But the scarcity of physical goods is turning a staple of all things into a luxury: chocolate.
This is just tragic for those of us with a sweet tooth. You have poor cocoa crop yields from extreme weather combined with this wild market turbulence. Cocoa futures tumbled 50% in 2025 after hitting record highs.
So manufacturers are getting desperate?
They are. They're cutting cocoa content or using alternatives like carob and sunflower seeds.
Meaning that cheap cookie or candy bar, it's probably no longer real chocolate.
Precisely. Some experts believe that high-quality real chocolate could soon become a luxury product, reserved for premium brands, while the budget stuff is filled by these substitutes. One source called it PTSD in the market.
Now let's look at two major regulatory fights that show how policy is struggling to keep up with both tech and abstract wealth. China's proposed AI rules and California's wealth tax debate.
This is where we see a fascinating leap in regulation. China is focusing on emotional safety.
Emotional safety. That's a step far beyond typical content moderation.
It is. They're proposing rules to prevent AI chatbots from generating content that encourages suicide, self-harm, or emotional manipulation.
That's a powerful move into the realm of simulated companionship and mental health.
It is. And the most critical component is the human safety net. The rule mandates that if a user proposes self-harm or suicide to the chatbot, a human has to immediately take over the conversation.
So it recognizes the emotional power these things hold.
Exactly. And the responsibility that comes with it.
Meanwhile, on the West Coast, California is having a very heated fight over money. Representative Ro Khanna embraced a proposal for a one-time 5% tax on billionaires.
Right, to fund healthcare. The proposal itself is controversial, but the opposition from Silicon Valley leaders, people like Nod Khosla and Alexis Ohanian, is furious for one specific reason.
And that is?
The tax would apply to unrealized gains.
We need to define that quickly. What are unrealized gains, and why is that such a flashpoint?
So for you, the listener, a gain is realized when you sell an asset, like a stock, and you make a profit. An unrealized gain is the paper value increase of an asset that you haven't sold yet.
Like illiquid startup stock.
Exactly. Venture investors are enraged because this would tax wealth that only exists on paper and can't be easily accessed. They're threatening to leave the state, arguing it just defies all common sense.
Okay, bringing it all back to the fundamentals of physical reality, our sources have some pretty sobering data on the state of housing quality in the U.S.
They do. Nearly 6.45 million U.S. homes, about 5% of the total housing stock, were classified as inadequate in 2023.
And this isn't just minor stuff.
No, 1.65 million of those were deemed severely inadequate. We're talking major deficiencies like exposed wiring, no hot water, serious structural issues, and older homes pre-1940 have the highest inadequacy rate at 9%.
And if we look at the financial side, who bears the greatest strain from living in these homes?
The burden falls disproportionately on renters, which really highlights a core systemic problem.
How so?
Well, 1.1 million renters in inadequate homes spend more than half their income on housing. Compare that to only 480,000 owners.
So owners might have the money to fix things, but renters are trapped.
Exactly. Renters face cost constraints, and crucially, they lack the control or incentive to improve a property they don't even own.
This just underlines the desperate need for affordable housing alternatives, which brings us to manufactured homes.
Right. Manufactured homes make up about 5.4% of housing, mostly in rural areas. But the cost advantage is truly compelling.
What are the numbers?
The average cost per square foot for a new manufactured home in 2023 was only $86.62.
$86. And for a site-built home?
$165.94. And that excludes the cost of land.
That's a massive savings of about $79 per square foot. So given that affordability, why aren't these homes solving the crisis in high-cost areas?
Zoning restrictions. Restrictive local zoning laws often limit where you can place them in urban or suburban areas where the need is most urgent. It's a policy failure, really, overriding a market solution.
And if we connect this to the broader picture of how we work, who has the flexibility to work from home? The telework light is still substantial, but it reinforces existing divides, doesn't it?
It absolutely does.
Mm-hmm.
The ability to telework is rapidly becoming a key indicator of class and education.
What do the demographics look like?
Women outpace men, 25% versus 19%. Age favors older workers. But education is the strongest filter. 38% of those with a bachelor's degree or higher telework.
And for high school graduates?
Just 8.4%. Fields like construction and hospitality, they remain firmly grounded with telework rates under 10%.
So this deep dive really showed us a world balancing, I guess, euphoria and anxiety. Record stock highs shadowed by commodity chaos, unprecedented diplomatic moves, and regulators struggling with AI's impact on our deepest emotions.
It raises an important question for you to consider as we look to the new year. We've seen an entire Swedish city move for mineral access. We have manufacturers fighting over the cocoa content in candy. And Silicon Valley is fighting a tax on wealth that, for many, only exists on paper.
Right.
So given these intense pressures, if physical reality, the need for minerals, homes, and real cattle hides is rapidly becoming the ultimate choke point, does that mean the ultimate investment and policy focus of 2026 shifts away from abstract value, like high-flying tech and unrealized wealth, back toward the unglamorous, tangible assets we all took for granted?